Waiting for your break-even point to adjust a butterfly isn't patience. It's mathematically guaranteed suicide for your P&L. When price touches your upper break-even, your position's negative gamma has likely peaked. You aren't just losing money. The speed of your loss is accelerating. You are fighting a losing battle against delta expansion that no simple roll can fix because the T+0 line is already too deep underwater. But here's the trap most traders fall into. They try to roll the entire butterfly to center it on the new price. This is inefficient. You incur slippage on 4 legs and reset your theta decay clock back to 0. The professional move isn't to move the mountain, but to widen the valley. Instead, we simply roll the untested wing toward the center. If the market challenges your call side, you roll your puts up. This converts the butterfly into an unbalanced iron condor or a broken wing butterfly. We are essentially selling a vertical spread against our threatened position to finance the risk. This flattens your delta exposure instantly without dismantling the core trade. However, keep the lesson from phase 3 in mind. By narrowing the structure, you are increasing the gamma risk if the market whipsaws back. You are trading directional risk for volatility risk. Ultimately, adjustments are about buying time, not performing miracles. If the cost to adjust exceeds 20% of your maximum potential profit, or if you cannot route for a credit, the math dictates you accept the loss. Don't throw good money after a bad probability. Preserve your capital first. Chase the recovery second.